Welcome to the Easy Super podcast, where we help everyday Australians take control and build wealth using the Self Managed Superannuation Fund. I'm your host, Natalia, and today we are talking about what is no doubt the biggest wealth creation story of the year. If you own an investment property or if you've been thinking about buying one, the rules of the game just changed. The 2026 federal budget delivered the most significant shake-up to the property and tax in the over 25 years. We saw the 50% capital gains tax discount completely scrapped for the individuals. We saw a new 30% minimum tax on capital gains introduced. And we saw negative gearing restricted to new builds only. For the average property investor buying in their personal name, or even through a standard family trust, holding property just became a lot less attractive and a lot more expensive. But there was one massive exception, one structure that the government left almost entirely untouched. And because of that, it has quietly become the single most powerful tax-efficient way to hold investment property in Australia today. I'm talking about your self-managed superannuation fund. Most people have not caught up to this yet, but the smart money is already moving. In the next 10 minutes, I'm going to break down exactly why an SMSF is now the ultimate property structure, how it completely bypasses the new budget taxes, and why getting you set up right from day one is the difference between building serious wealth and making a very costly mistake. Let's get into it. To understand why SMSF is so powerful right now, we first need to look at what just happened to everyone else. Let's talk about capital gain tax, or CGT. For decades, if you bought a property in your own name and held it for more than 12 months, you got a 50% discount on the capital gains tax when you sold it. That was the golden rule of Australian property investment. As of July 1st, 2027, that discount is gone, replaced by an indexation method and a new 30% minimum tax rate on the real gains. If you hold property in a family trust, you are also facing a new 30% minimum tax on distributions from 2028. Then there is negative gearing. Under the new rules, if you buy an established residential property after budget night, you can no longer negatively gear it against your salary. You can only negatively gear newly built homes. If your property runs at a loss, those losses are quarantined. So, if you're buying an established property today in your personal name, you're walking into a trap of restricted tax deductions while you own it and higher capital gains tax when you sell it. But what did the budget say about superannuation? Nothing. They left it alone. The standard 15% tax rate on super earnings, unchanged. The 0% rate in the pension phase, unchanged. And crucially, the 1/3 capital gains tax discount that applies inside superannuation, completely untouched. Negative gearing still exists in SMSF. This means the gap between investing in your personal name and investing through your super fund has never been wider. Now, if you are listening to this and thinking, I need to look at this seriously, you are not alone. This is the number one question we are getting at Easy Super right now. We are offering a free 10-minute consultation where we will explain how an SMSF property purchase works, what is required at each stage, and the steps involved in completing the transaction. Head to easysuper.au, that easysuper.au, and click Get Started. It takes 30 seconds to book. All right, let's keep going because the numbers are about to blow your mind. Let's look at what this actually looks like in practice when you buy property through a self-managed super fund. First, let's talk about rental income. If you own a property in your personal name, the rent you earn is added to your income and taxed at your marginal tax rate, which could be up to 47%. Inside an SMSF, rental income is taxed at a flat rate of just 15%. That means more cash flow stays in your fund to pay down the debt faster or reinvest. Second, let's look at negative gearing. While the government restricted negative gearing for individuals buying established properties, those rules do not apply to SMSFs. If your SMSF borrows money to buy an established property and the interest and expenses exceed the rental income, your fund can still claim that loss against its other income. For example, your employer superannuation contributions. But the biggest advantage, the absolute game changer, is capital gains tax. Let's say your SMSF buys a property today, and in 15 years, it has gone up in value by $500,000. If you sell that property while your SMSF is still in accumulation phase, the maximum capital gain tax you will pay is just 10%. Compare that to the new 30% minimum tax outside of super. But it gets better. If you hold onto that property until you retire and you move your SMSF into the pension phase, your tax rate drops to 0% capital gains tax. You could sell a property for $1 million profit and every single cent stays in your fund to fund your retirement. No other legal tax structure in Australia offers you a 0% tax environment. This is why we are seeing such a massive surge of interest. Everyday Australians are looking at their super balances, looking at the new budget rules, and realizing that their super is the perfect vehicle to buy bricks and mortar. Look, I know those numbers are powerful. 0% CGT in pension phase, 15% flat tax on rent, unrestricted negative gearing. It's a completely different world from what individual investors are now facing. But here's the thing. None of this works if your fund isn't set up correctly. And that's what I want to talk about next, because this is where we see people lose hundreds of thousands of dollars. If you want to make sure you don't fall into the trap, book your free 10-minute consult at easysuper.au right now. All right, let's talk about the catch. Hearing all of this, you might be thinking, this sounds incredible. I'm going to go set up SMSF online right now and buy a house. Stop. Please listen to me very carefully. Property through super is incredibly powerful, but it is heavily regulated. And this is where we see so many people make disastrous mistakes by trying to go to the cheap do-it-yourself route. To buy property with a mortgage inside an SMSF, you cannot just take out a standard home loan. By law, your fund must use what is called a limited recourse borrowing arrangement, or an LRBA. Under an LRBA, the property isn't actually held directly by the SMSF. It must be held in a separate legal structure called a bare trust, with a separate corporate trustee until the loan is completely paid off. The rules around this are strict. The bare trust company must be registered before you sign any property contract. The property must be a single acquirable asset, meaning you can't buy a house and a land package on two separate contracts under one loan, and you can't use borrowed money to make structural improvements to the property. We see it all the time at Easy Super. Someone goes to a cheap online setup service. They get a basic, generic trust deed that never even contemplated property investment. They go out, they find the perfect investment property, they sign the contract in the name of the SMSF, and then they go back to the bank for a loan. The bank looks at it, sees there is no bare trust in place, sees the contract is signed in the wrong name, and rejects the loan. The compliance is breached. The contract crashes. And the trustee is left stuck, stressed, and often facing heavy financial penalties. A budget setup leaves you stranded when the right opportunity comes up. When you're dealing with hundreds of thousands of dollars, and the ATO looking over your shoulder. You do not want a generic setup. You need a structure built specifically for property investment from day one. You need education. You need to understand how SMSF works. And this is exactly where the specialist setup earns its keep. And it's exactly what we do at Easy Super. We don't believe in one size fits all. We're a compliance first firm. When we set up your SMSF, we ensure your trust deed is robust, your corporate trustee is established correctly, and if you're borrowing to buy property, your bare trust and LRBA documentation are bulletproof before you even going to open homes. We handle the setup, the tax, the ongoing compliance, and the annual auditing. We make sure you are operating entirely within the ATO's rules, so you can focus on what actually matters, finding the right property and growing your wealth. With the 2026 budget changes, the window of opportunity is clear. Holding property in your personal name is getting harder. Holding it in your SMSF has never looked better. But it only works if your structure can actually do it. So here's what I want you to do right now. Whether you're thinking about buying a property through your super for the first time, or you already have an SMSF and you want to make sure your structure is ready for property investment, do not leave it to guesswork. We are offering a free, no obligation 10-minute consultation with our SMSF team. We will explain you how property can be purchased through an SMSF. We will review your current structure, identify any outstanding setup or compliance requirements, and walk you through the process from fund setup through to the property settlement. Head over to easysuper.eu and book your free consultation. Take control of your super the easy way. Thanks for tuning in. I'm Natalia, and I'll see you on the next episode of the Easy Super podcast.